Meet Miles. Like millions of people around the world, he has just received his monthly salary. Feeling responsible, he walks into his bank and deposits the money into his account. Within seconds, the balance on his phone updates, and he smiles, believing his money is now sitting safely inside a giant bank vault, waiting for him whenever he needs it. But that's not what actually happens. A friendly banker smiles at Miles and says, "Your money is safe, but it is just sitting in a vault." Miles looks confused. Then where did it go? The banker explains that banks are much more than places that store money. They are financial businesses whose main job is to connect people who have extra money with people who need to borrow it. Every day, millions of people deposit money, while millions of others borrow money to buy homes, start businesses, pay for school, or purchase cars. As Miles' money enters the bank, it joins thousands of other deposits. Instead of locking all that money away, the bank puts much of it to work by making loans. Miles watches a family receive a home loan, a student pay for college, a farmer buy new equipment, and a small business owner open a new cafe. His deposit has become part of something much bigger. Miles asks, "But if the bank lends out my money, what happens if Moat want it back tomorrow?" The banker explains something called fractional reserve banking. Banks know that not every customer withdraws all their money at the same time. Because of this, they keep only part of their deposits available as reserves while lending the rest. This allows banks to serve customers who need cash while also helping the economy grow through lending. Miles watches an example. Imagine 1,000 people each deposit $100. Together, the bank receives $100,000. Instead of storing every dollar inside a vault, the bank keeps enough money available for normal daily withdrawals and lends part of the remaining funds to qualified borrowers. One customer receives a loan to buy a house. The home seller deposits the payment into another bank. That second bank can now lend part of those new deposits to someone else. The cycle continues, allowing money to circulate throughout the economy instead of sitting still. Now Miles understands why banks are so important. They help money keep moving. But how does the bank make money? Miles asks. The banker smiles and replies, "Interest. When someone borrows money, they repay more than they borrowed. That extra amount is called interest. For example, if someone borrows $10,000 with interest, they'll repay more than $10,000 over time. At the same time, the bank pays a smaller amount of interest to people who keep money in savings accounts. The difference between the interest the bank earns and the interest it pays is one of its biggest sources of profit. Banks also earn money through account fees, payment services, credit cards, business banking, investment services, and international money transfers. Miles begins to wonder, what if someone never pays the loan back? The banker explains that lending always involves risk. Before approving a loan, banks carefully examine each applicant. They look at income, employment, existing debts, repayment history, and credit scores to estimate whether the borrower can repay the loan. Sometimes people lose their jobs, businesses fail, or unexpected emergencies make repayment impossible. These situations are called loan defaults. Because of this risk, banks never lend all their money to just one person. Instead, they spread loans across thousands or even millions of borrowers so that one unpaid loan won't threaten the entire bank. Miles notices another important building connected to every bank, the central bank. Unlike ordinary banks, the central bank does serve everyday customers. Instead, it helps manage the country's financial system. It supervises commercial banks, influences interest rates, manages the money supply, and works to keep the economy stable. When the economy slows down, the central bank may lower interest rates, making borrowing cheaper so businesses and families spend more money. When inflation rises too quickly, it may raise interest rates, making loans more expensive and encouraging people to spend less. These decisions affect everything from mortgages and business loans to savings accounts. As Miles continues exploring, he notices something else. Hardly anyone is carrying large amounts of cash anymore. People tap their phones, swipe debit cards, shop online, and transfer money instantly. Behind every one of those transactions, banks communicate through secure computer networks. They verify balances, check for fraud, authorize payments, and move money between accounts in just a few seconds. Although everything appears instant, An enormous financial system is working behind the scenes. By the end of the day, Miles realizes that banks do far more than simply hold money. They protect deposits, process payments, provide loans, support businesses, help families buy homes, finance education, create jobs, and keep money flowing throughout the economy. He smiles as he looks at his bank account once more. His money isn't trapped inside a vault. It's part of a much larger system that helps businesses grow, supports communities, and powers the modern economy every single day. The next time you deposit money into a bank, remember Miles' journey. Your money is just sitting still. It may already be helping someone build a home, start a business, create jobs, or achieve a dream. That's how banks actually work.